Hi everyone, this is 4.2 Global Markets and Business Expansion. And so in this unit, in this section of theme 4, we're going to have a look at how trade kind of happens, how trade is prompted, and more importantly, we're going to start focusing on why countries are chosen by businesses for different means, whether that's as a market, whether that's as a production location. We're also going to look at how businesses interact with different countries. So for example, this could be through a global merger or a joint venture, and just generally speaking, how global competitiveness is important for different businesses. So in terms of conditions that prompt trade, typically we have two categories of factors. We've got push factors and pull factors. The pull factors are when an attractive feature of an international market pulls a business into that market. So this could be a variety of different things, such as maybe lower costs, maybe the ability to gain economies of scale. Maybe it's just to spread risk. You know, the whole concept of don't have your eggs all in one basket. That could link to this concept here where businesses might be pulled into other countries just to avoid the risk if the country that they're in becomes saturated. The push factors, on the other hand, are reasons why you might decide to leave a domestic market and potentially go into a different market. And this could be, for example, if you have huge amounts of competition, if it's a saturated market, that might prompt you to decide that actually, in terms of the profits and the success of your company, you might have to go and work and operate somewhere else. There is also the concept of outsourcing and offshoring that you must be aware of. So outsourcing is where you get another company to do something for you. So this could be, you could outsource production, you could outsource customer service, you could outsource the management of your website, or a variety of different things. But obviously, when we're talking about this in terms of global markets, we're talking about outsourcing something to a different country. And then we also, on the other side of that, have offshoring, which is an alternative approach where you do it yourself, but you do it in a different country. So you might well decide that your factory in York isn't profitable enough or isn't efficient enough, and you're going to move it to a different country. Maybe a country that, for a variety of different pull factors, has cheaper labor or has better shipping arrangements or better location in terms of getting your product to the countries you need to get them to. The second part of this unit, which is a really, really important part, is when we're assessing countries as a market or assessing countries as a production location. And the key thing here is that when a business is deciding where to locate, they're going to consider different factors if it's a market to if they're choosing a production location. So we're going to go through the different factors that they would potentially consider when deciding to target a particular market. So the first is disposable income. Naturally, of course, it makes sense. If you want to sell a product in a certain place, you need to ensure that the customers in that market have enough money to be able to buy your goods. And this obviously is even more important for products of a higher end, products with more levels of differentiation. You also have to consider the income growth levels. So there may be a country that actually doesn't have a huge amount of disposable income currently, but might have in the next 5 to 10 years. And so if you can operate in a country as a first mover, you potentially can build brand image and build a reputation as the income growth occurs. And then when the income is of a high level where really potentially sales can kick on, you might find that you've already developed your business as the market leader in that area, or certainly a business that has enough market share to be able to take advantage of that increased growth. Ease of doing business is also a factor, and that could be for a variety of different areas. That could be through bureaucracy and paperwork. It could be through legislation. It could be through the barriers that we mentioned in 4.1. And it could be in terms of infrastructure as well. The exchange rate could be favorable. So you may be able to get a price advantage or a cost advantage by selling your products in a certain area based around the exchange rate. Certainly think of spiced when we talk about the exchange rate there. We will talk about spiced in theme 4 separately. The existing levels of competition within a country are also really important. If there are huge amounts of competition, you may decide not to go for that market. If there are some competition, but not necessarily anything you don't think you can beat, then that might be a potential pull factor that would pull you into that country. In terms of production location, the obvious one is production costs. The production costs, from a business perspective, they'd want those to be cheaper, because if the costs are cheaper for production, that suggests that a business is either going to be able to do one of two things: lower their selling price or increase their profit margins. It may be focusing on the labor force skill and availability. So you may decide to operate in a country where you know there is a supply of labor that you will be able to do the job to the right standard. It could be wage rates, which is one of the most common reasons why countries are chosen to be a production location. If wage rates are significantly lower, that obviously has a significant impact on production costs. And again, as I've mentioned, selling price or profits. Infrastructure is really important. The ability to deliver, the ability to communicate, all of those are going to be factors that businesses will consider when they're choosing a production location. Potentially whether the country is part of a trading bloc, especially if you are hoping to target consumers as a market in other countries in that trading bloc. Manufacturing in that production location within that trading bloc can lead to huge savings in terms of those barriers to trade that we talked about in 4.1. And also natural resources. If you want to be close to certain natural resources because you need them in your production, then that might be a perfectly valid reason to choose to produce in a certain area. We also have government incentives. So we've seen plenty of examples of governments that have kind of bent over backwards to get big businesses into their country. We've seen examples of this with Ireland and Apple. We've seen far more than that example where they've offered potentially tax breaks. They've offered potential incentives to try and kind of have their country be the headquarters of a big multinational corporation. And obviously that return on investment is really important as well. You need to make sure that if you are going to invest a huge amount of money into creating a manufacturing site, potentially creating a production location, you need to make sure that that is going to return on your investment. 424 is global mergers and joint ventures. We have studied mergers before. Mergers comes up in theme 3. We just need to make sure it's clear that what the difference is between a merger and a joint venture. So a merger is where two businesses come together to create one new business. The previous two businesses cease to exist. A joint venture is two businesses coming together, but on a temporary basis. This could be, for example, for a product launch. This could be for a project. This could be for a one move into another country where rather than do it yourself, you may pair up with a business that's already there. So, for example, a clothing retailer might go to a different country and pair up in a joint venture with an existing clothing company to kind of be able to have a mutual advantage there. Why would you do this? Well, there's a few reasons. Spreading risk, of course, is one. Rather than doing all of the investment yourself, going through a joint venture or going through a merger potentially allows that risk to be spread. It could be just to simply enter a new market or trade block, and you might decide that rather than organic growth, an inorganic growth strategy might be the most effective way of doing that effectively. It could be to gain expertise on other markets. So if a merger is one business or a joint venture is one business in one country, in maybe potentially the external country, and then the other party is in the market that you're hoping to target, by merging with them or going through a joint venture with them, you may gain expertise on how that market works. It's always said that, of course, the more expertise we have, the less risky a strategy is. It could be to secure resources. So, for example, we may do a merger with a company that has access to certain materials or resources that we need, similarly the joint venture. And it could be to acquire international or national brands or patents. So rather than potentially going in without any kind of brand image, we may do a joint venture with a business that already has a level of brand awareness in that country, which might just make that whole process easier for us to kind of gain penetration into that market. The last topic in this is 4.2.5, global competitiveness. And this question revolves around what affects how competitive a business is on the global scale. So the first thing to be aware of is our competitive advantage. How do we gain our competitive advantage? Is that through low cost of differentiation? This was mentioned in 1.1.3. So if you go and watch the 1.1 video, you'll see a little bit about low cost versus high levels of differentiation. Of course, it goes without saying that in some countries, some of these competitive advantages are easier to gain than others, and some are more competitive than others. The other factor that's worth considering is the exchange rate. And we mentioned exchange rates earlier when we did 4.2.2. One thing to remember whenever you do exchange rates, and we'll talk about this in the 2.5 video, that we need to be aware of spiced. Spiced meaning strong pound, imports cheaper, exports dearer. So when we have a stronger pound, an appreciating pound, we would find it cheaper to import from abroad because our currency would be worth more of the foreign currency. So when we exchange our currency, we will get more of whatever it is we're buying, materials, goods, what have you. But foreign consumers will find that they will have to pay more for our products. So if we are exporting to a different country, we would probably prefer a weaker exchange rate. The opposite of this is also true. So spiced works really nicely. It rolls off the tongue. Wapidec doesn't. I know some people say YDEC, but either way, all you really need to know is it's just the opposite of when we have spiced. So a weaker pound means imports are dearer. It also makes exports cheaper. And so those factors will have an impact on how competitive a business can be on a global scale. So that covers 4.2. As I've mentioned in all of the other videos, because, this is what people on YouTube do. They mention the same kind of reminders at the end of every video. Have a look at the resources available in the description. Have a look at the other videos. There is all of theme 1 and all of theme 4 up ready for paper 1. If you're focusing on paper 2, then you want to be having a look at theme 2 and 3 when they're available, if they're not already available by the time you watch this. If you've got any questions, chuck them in the comments, and hopefully this will have been able to help you. Thank you very much.